During the 2020 market crash caused by the COVID-19 pandemic, many hedge funds faced extreme volatility and rapid declines in equity markets. Instead of liquidating long-term equity positions, which could trigger taxes or reduce long-term exposure, these funds turned to index futures. For example, by shorting S&P 500 futures, a hedge fund could offset expected losses in its stock portfolio. If the market dropped 10%, the futures position would generate gains that neutralize portfolio losses. This strategy allowed them to stay invested while managing downside risk. Such real-time application of linear derivatives illustrates their practical relevance in institutional portfolio management. Linear derivatives are financial instruments whose value changes in direct proportion to the price of the underlying asset. The relationship between the derivative and the underlying asset is linear. That means if the price of the underlying moves by $1, the value of the derivative moves by a predictable and proportionate amount. These instruments include forwards, futures, and swaps. They are commonly used in risk management, speculative trading, and pricing of more complex products. Their standardized nature makes them fundamental in the world of financial markets. A forward contract is a private, customized agreement between two parties to buy or sell an asset at a specified price on a future date. These contracts are over-the-counter, meaning they are not traded on formal exchanges. While flexible in terms, they carry counterparty risk. A futures contract is a standardized agreement traded on an exchange to buy or sell a specific asset at a predetermined price at a future date. Futures are marked to market daily, meaning gains or losses are settled at the end of each trading day. Exchanges such as the Chicago Mercantile Exchange or Eurex act as intermediaries and guarantee the trade. Swaps are contracts in which two parties exchange streams of cash flows. The most common types are interest rate swaps and currency swaps. For example, one party may agree to pay a fixed rate while receiving a floating rate, which allows them to hedge interest rate exposure. Linear derivatives allow institutions to hedge risk exposures. For example, a wheat producer can lock in a price with a futures contract to avoid loss from price drops. Banks use swaps to manage interest rate risk on loan portfolios. Traders also use linear derivatives for speculation. They can bet on the direction of an asset without owning it. Futures contracts on commodities, stock indices, or currencies are frequently used to take leverage positions. Additionally, linear derivatives are essential in arbitrage strategies. Traders exploit pricing inefficiencies between the spot and futures markets or between markets in different regions. One of the defining traits of linear derivatives is their symmetrical payoff, meaning profits and losses rise linearly with the underlying asset's price movements. These contracts are obligation-based, which means both parties are bound to perform at maturity. Another characteristic is mark-to-market. Particularly in futures contracts, daily price movements affect account balances through variation margins. Linear derivatives also offer leverage. They require only a margin deposit rather than full notional exposure, which increases both the potential for gains and the risk of losses. Linear derivatives form the core of modern financial risk management. Because their pricing and risk exposure are easier to understand than those of non-linear products like options, they are typically the first derivatives introduced in financial education. They are widely used by central banks to hedge reserves, by corporations to manage currency or interest rate risks, and by hedge funds to tactically adjust exposure. Grasping the logic of linear derivatives is essential before progressing to more complex instruments like options, structured products, and hybrids. Airlines are heavily exposed to fuel price volatility, which directly affects their profitability. To manage this risk, many airlines enter into forward contracts with fuel suppliers. For example, an airline might agree in January to purchase jet fuel at $80 per barrel for delivery in June. If prices spike to $100 by then, the airline saves $20 per barrel thanks to the forward contract. This forward-based hedging strategy allows companies to stabilize costs and protect margins against unexpected price swings. A forward contract is a private agreement between two parties to buy or sell an asset at a specified price on a future date. Unlike futures contracts, forwards are customizable and traded over the counter, meaning they are not standardized or regulated by an exchange. Common underlying assets include commodities such as oil or gold, currencies like the United States dollar against the Japanese yen, and financial instruments such as treasury bills or corporate bonds. Forward contracts offer a high degree of customization. The terms of the agreement, including quantity, price, and settlement date, can be tailored to the specific needs of both parties. Typically, no initial payment is required at the time the contract is initiated. However, since forward contracts are conducted over the counter, they carry counterparty risk, meaning there is a chance that one party may default. Additionally, these contracts are non-transferable, making them specific to the original counterparties involved in the agreement. The price of a forward contract is generally calculated using the cost of carry model. The formula is as follows. Forward price equals spot price multiplied by 1 plus the risk-free interest rate raised to the power of time to maturity. This formula ensures that the forward price reflects the time value of money, as well as any storage or financing costs associated with the underlying asset. Corporations can use forward contracts to lock in foreign exchange rates when they expect to receive large payments in foreign currencies in the future, such as 3 months ahead. Exporters and importers often use forward contracts to manage fluctuations in revenue or costs due to currency volatility. Investors may also use forwards to take long or short positions in assets that are not easily traded on the spot market. Commodities producers, such as oil or grain companies, use forward contracts to secure predictable pricing and ensure more stable future cash flows. One of the primary risks of forward contracts is credit risk, or the risk that the counterparty might default on the agreement. In addition, forwards typically lack liquidity, making it difficult to exit the contract before maturity. Unlike futures, forward contracts are not settled on a daily basis, so losses can accumulate over time without any interim settlements, a feature known as the absence of mark-to-market. Lastly, forward contracts usually do not require margin deposits, which lowers the barrier to entry but increases exposure to counterparty risk. Understanding these differences is essential when selecting the appropriate derivative instrument for hedging purposes or speculative strategies. Forward contracts provide flexibility and customization, while futures offer liquidity, transparency, and reduced credit risk. Commodity traders like Cargill or Glencore routinely use futures to hedge price risk. Suppose a wheat exporter expects to ship 10,000 tons of wheat in 3 months. If prices drop, their revenue could fall sharply. By selling wheat futures today, they lock in a price and hedge against a potential price decline. If the market drops, the loss on the physical delivery is offset by gains on the futures contract. This is a prime example of how futures help stabilize earnings in volatile markets. A futures contract is a standardized legal agreement to buy or sell a specific quantity of an asset at a predetermined price on a future date. These contracts are traded on organized exchanges like the CME, Chicago Mercantile Exchange, and are used widely in equities, commodities, interest rates, and currencies. Standardization ensures high liquidity, transparency, and the involvement of a clearinghouse reduces credit risk. Standardized terms mean that quantity, quality, delivery time, and location are all predefined. These contracts are exchange-traded, which ensures liquidity and fair pricing. Positions are subject to daily settlement, meaning all positions are marked to market every day. A clearinghouse acts as counterparty to all trades and reduces default risk. To open a futures position, traders must post an initial margin, a fraction of the total contract value, usually 5 or 15%. This acts as collateral. There are several types of margin. Initial margin is required to initiate a position. Maintenance margin is the minimum account balance to keep the position open. Variation margin refers to funds added or removed daily based on gains or losses. If the account balance falls below the maintenance margin, a margin call is triggered, requiring the trader to add funds or close the position. Futures positions are revalued daily to reflect market changes. Gains or losses are credited or debited to the margin account. For example, if a trader holds a long futures contract on oil and the price increases by $2 per barrel, the gain is immediately added to the account the same day. This ensures transparent, real-time risk management, but also means losses must be covered instantly. Opening a futures contract occurs by buying or selling. Mark-to-market involves daily valuation that adjusts the margin account. Closing the contract is done by taking an opposite position or through final settlement. Settlement can take two forms. Physical settlement requires delivery of the asset, while cash settlement is based on price differences. Hedgers, such as producers, exporters, and importers, use futures to fix prices. Speculators are traders betting on price direction using leverage. Arbitrageurs exploit price inefficiencies between futures and spot markets. Leverage amplifies losses because small price moves can lead to significant gains or losses. Liquidity risk may arise in less active contracts, as not all futures contracts have deep order books. Basis risk occurs when the futures price does not move perfectly in sync with the underlying asset. Understanding these risks is crucial for anyone trading or hedging with futures. In the 1980s, IBM wanted to borrow in Swiss francs due to favorable interest rates, while a Swiss company wanted exposure to USD debt. However, neither had the market access or cost efficiency to do it directly. The two companies used a currency swap. IBM issued USD debt and swapped the interest and principal payments with the Swiss company, who did the opposite. This allowed both firms to benefit from better rates in their local markets while achieving their intended currency exposure. This case is often cited as a textbook example of how swaps create mutual financial advantages. A swap is a financial derivative in which two parties agree to exchange streams of cash flows over a specified period. Swaps are typically traded over the counter, OTC, and used for hedging or altering exposure to financial variables such as interest rates or currencies. An interest rate swap involves exchanging fixed rate interest payments for floating rate payments, or vice versa. Example, Company A has a floating rate loan but prefers fixed payments. Company B has a fixed rate loan but wants to benefit from falling rates. They agree to swap interest payments, allowing both to manage risk according to their outlooks. The most common type is called plain vanilla, which involves fixed versus LIBOR or SOFR-based floating rate. A currency swap involves exchanging both interest payments and principal in one currency for those in another. These swaps are used when a firm needs to fund operations in a foreign currency or when a company wants to hedge currency risk on foreign assets or liabilities. Unlike interest rate swaps, currency swaps involve an initial and final exchange of principal amounts. Risk management allows protection against interest rate or currency fluctuations. Access to cheaper financing lets firms borrow in domestic markets and swap to desired exposure. Customization means terms can be tailored to specific needs such as notional amount, duration, and frequency. The lack of exchange trading due to the OTC nature offers flexibility but also introduces counterparty risk. Valuation of swaps is done as the difference in present value of future cash flows between the two legs. Mark-to-market practices apply, as their value can fluctuate and may require collateral. Credit risk is managed through collateral agreements and clearing mechanisms such as central counterparties. Regulatory impact from post-2008 reforms has pushed many standardized swaps toward clearinghouses. Corporates use swaps to lock in financing costs or convert loan currencies. Banks employ swaps to hedge mismatches in asset liability profiles. Hedge funds use them to speculate on rate differentials or macro themes. Governments and agencies utilize swaps to manage sovereign debt exposure or currency reserves. During the GameStop GME trading frenzy in early 2021, many retail traders across Europe and Asia turned to contracts for difference (CFDs) instead of directly buying the underlying shares. CFDs allowed them to take positions in GME without needing full capital or direct ownership. This enabled leveraged exposure, short-selling opportunities, and quick entries and exits with lower capital requirements. However, some traders also faced heavy losses due to the amplified effects of leverage. This example illustrates both the appeal and the risk of synthetic instruments in volatile market environments. A CFD is a financial derivative that allows traders to speculate on price movements of an asset without owning the asset itself. The contract pays the difference between the opening and closing prices. CFDs can be used on stocks, indices, commodities, forex, and cryptocurrencies. No ownership means traders don't own the actual stock, commodity, or asset. Leverage allows CFDs to be traded on margin, enabling greater exposure with less capital. The bid-ask spread is where broker profits come from, not commissions in most cases. Dividends and corporate actions are still relevant, as traders may receive dividend adjustments when holding CFDs on dividend-paying stocks. Pros include access to a wide range of markets from one platform, the ability to go long or short easily, low capital requirement, and fast execution. Cons involve higher risk due to leverage, no shareholder rights such as voting, financing costs for overnight positions, and regulatory restrictions in some regions. Synthetic instruments replicate the economic performance of an asset but don't confer legal ownership. Examples include CFDs, total return swaps, and synthetic ETFs. Underlying assets involve direct ownership. For example, buying Apple stock gives you a share of the company and voting rights. Comparison shows synthetic tools are better for short-term speculative trades, while underlying assets are better for long-term investing and wealth building. Counterparty risk arises because you depend on the broker or issuer to honor payouts. Leverage risk means losses are amplified with small price movements. Market gaps and slippage can occur as high volatility leads to wider spreads or execution at worse prices. Lack of transparency is another concern, as the pricing mechanics of synthetic products are not always clear to retail investors. Short-term trading makes these ideal for day traders or swing traders. For hedging, they're useful in protecting downside in a stock portfolio without selling. They're also suited for speculation in hard-to-access markets, allowing exposure to foreign stocks, indices, or commodities not listed on your home exchange. Understanding when and how to use synthetic instruments is key to managing risk and optimizing performance.